Hey everyone, welcome back. We're doing a deep dive today into something I think we all can get behind as small business owners, right?
Yeah,
Saving money on taxes.
absolutely.
And we were going to be looking at 20th windfall tax savings approved for small business owners
Okay.
and pulling some choice bits out of that, as well as some insights from the tax expert Dan Pilla's website.
Right?
So we can uncover maybe some of those serious tax saving strategies that maybe you're overlooking.
Yeah, you might be surprised just how many things you could be doing to really either get money back or increase your take home
Right. Or increase your take home every month, right?
every month.
Who
Yeah,
wouldn't want that?
absolutely.
So let's jump right in.
Okay.
One of the things I think trips up a lot of, especially small businesses, especially home based businesses, is kind of separating fact from fiction when it comes to what you can and can't deduct on your taxes.
Absolutely. There are a lot of misconceptions out there.
Okay, so let's bust some of those myths wide open right now. Myth number one, you have to show a profit 3 out of 5 years to qualify for small business tax breaks.
Well, not really. The IRS is more interested in your intent to make a profit. You can actually have losses for several years and still be okay.
Okay, so even if I'm in the red for a while, as long as I can show that I'm genuinely working towards profitability,
Sure.
I'm still in the game.
Exactly.
That's
Think about Amazon.
Oh wow, run.
They operated at a loss for years, strategically reinvesting their earnings to build their empire, but they meticulously documented their journey and they showed that clear path to future profitability. And what happened? They became a global powerhouse.
Okay, so the Amazon example is inspiring. It shows that losses aren't always a bad thing,
Exactly.
especially if you have a solid plan and the documentation to back it up.
That's right.
Okay, myth number two: you need an entire room dedicated exclusively to business to claim the home office deduction.
Nope.
Now, a lot of people might be working from, a corner of their living room or a shared space.
Right.
Does that mean we're out of luck?
No, you don't need an entire room, but you do need a defined space that's used exclusively for business.
Okay.
So if you have like a desk in your bedroom that you only use for business activities, that could work.
So as long as it's like a visually identifiable and exclusive use space, even within a room, that could work.
Exactly. The key is to be able to show that this area is clearly dedicated to your business activities.
That's good news.
Yeah.
For those of us who don't have a sprawling home office,
Right.
okay, so we've kind of busted those myths.
Okay.
Let's talk about that home office deduction because it can be really powerful.
It's all about the business use percentage, the BUP, and that
Yeah.
determines how much of your home expenses, like your mortgage interest or your rent utilities, even repairs homeowners insurance that you can deduct.
Okay, so the BUP is kind of like the magic formula for unlocking those deductions.
Yeah.
How does that look in practice?
Well, let's say you're a wedding photographer. If you have pictures displayed around your house, almost like a product display area,
Right.
that can really boost your BUP because you're essentially turning your living space into a marketing tool,
Oh, that's so clever.
right?
It's like turning your house into a tax saving billboard.
Right.
I love it. What if it's not a visually focused business?
Yeah.
What about someone who's maybe doing something else?
Yeah.
How can they use the BUP to their advantage?
Think about repurposing spaces.
Hmm.
Maybe you're using your dining room for business tasks like fulfilling orders or storing product samples or doing admin work. So, even if it's not a dedicated office space, that consistent business use makes it eligible.
Okay, so there are ways
Yeah,
that with a little creativity and planning, we can really maximize
absolutely.
our deductions.
Yeah.
Now, let's get to the really fun part, in my opinion,
Okay.
turning personal expenses into business deductions.
Yeah, this is where things get interesting because there are actually a lot of everyday expenses that you probably are already doing, incurring that you could be writing off.
Okay, give us an example. What kind of personal expense could magically transform into a business deduction?
Okay, so let's say every year you send out holiday cards to clients and colleagues.
Okay.
Instead of just getting those generic cards from the supermarket, you get custom cards made with your business logo on them. You have a nice little message in there promoting your services.
Right.
Boom, holiday cards, postage gifts all of a sudden become tax deductible marketing expenses.
Wait, seriously? So my holiday cheer could actually save me money on my taxes.
It's possible.
That's amazing.
Yeah.
But I have to ask, with all these deductions, won't the IRS kind of get suspicious?
That's a valid concern. And that's where the audit defense business plan from the book comes in.
Okay.
It goes through the 9 things the IRS uses to determine if you are really intending to make a profit.
Okay.
So it kind of guides you through that documentation process so that you're prepared to answer those
So it's
questions.
not just about claiming the deductions, it's about being able to back it up.
Exactly.
Okay, so
Yeah.
this is like an insurance policy
Yeah.
for your tax
Yeah.
deductions. Now, for what I think is maybe the most fascinating strategy in here is the idea of hiring family members,
Okay.
especially kids.
Uh,
It sounds almost too good to be true.
well, it's an incredible opportunity both for tax savings and for teaching your kids some really valuable life lessons.
Okay, so break this down for me. How does this whole family hiring thing work from a tax perspective?
For starters, there are no withholding requirements for children under 18.
Okay,
That means you can potentially pay them up to a certain amount every year, completely tax free.
hold on, tax free. You sure this is legal?
It is absolutely legal for 2020. The annual gift tax exclusion was $15,000 per recipient. So you could give each child up to $15,000 without having to pay any gift tax.
Oh, wow.
And if they're working for your business, those payments are considered wages, not gifts.
So you're telling me I could potentially pay for my child's college tuition, their first car, maybe even contribute to their wedding fund with tax-free dollars?
You absolutely could. And it's a great way to teach your kids about responsibility and earning money. But it is crucial to remember that the wages you pay your children must be reasonable. And you need to be able to justify those wages based on what they're doing their age and how that compares to the prevailing rates in your area for similar work.
Right. It can't look like I'm just handing my 10-year-old a hefty paycheck for doing a few chores around the house.
Right.
The IRS would see through that.
They would.
What about documentation?
Yeah.
What kind of records do I need to keep when I'm hiring my kids?
Documentation is essential. You need to have really detailed work logs that track what they did, how many hours they worked, the dates, all of that.
That sounds like a lot of paperwork.
It can be, but luckily there's technology for that. There are apps like BusyKid that make this process so much easier and more fun for kids.
Really?
Yeah, they can track their hours, they can manage their earnings, they can even learn about budgeting and saving.
So we're turning tax compliance into like a fun life lesson. I love it.
Exactly. It's a win-win.
I think we've covered a lot of ground already in this first part of our deep dive.
Yeah.
We've busted some myths,
Yes.
explored the magic of the home office deduction,
Uh-huh.
and even uncovered the incredible potential of hiring family members.
It's true.
Stay tuned for part two, where we'll uncover even more of these tax saving gems.
I can't wait.
Welcome back, everyone. I'm still reeling from that last revelation about hiring family members.
Yeah.
It's incredible how many, like, tax saving opportunities there are if you know where to look.
Absolutely.
Speaking of hidden gems, I would love to talk about something that's a major pain point for a lot of us, and that is health expenses.
Yeah,
It feels like those costs just keep going up and up.
absolutely. And that's why maximizing your deductions when it comes to healthcare is so crucial.
Okay, so how can we potentially turn those healthcare costs into tax savings? What's the secret weapon?
Well, it's called the Health Reimbursement Arrangement or HRA,
Okay.
and it's like a personalized healthcare savings account that's packed with tax advantages.
Okay. I'm intrigued. What kind of expenses does an HRA actually cover?
It covers a wide range of expenses, both expected and maybe unexpected. So we're talking premiums, deductibles, co-pays, even things that traditional insurance often doesn't cover.
Right.
Orthodontics, vision care, chiropractic treatments, even some over-the-counter medications.
Wait, hold on. Did you say over-the-counter medications like the stuff I just grab at the drugstore?
You got it can really broaden your definition of what's considered a deductible medical expense. And the book mentions that HRA users saw an average increase of $5,000 in their tax refunds.
$5,000. Okay, now I'm really paying attention, but how do I get in on this HRA action?
Okay.
What are the qualifications?
There's two main paths to this one is to hire your spouse as an employee.
Okay.
Remember we were just talking about the tax benefits of employing family members?
Yes.
The other option is to incorporate your business and become an employee of your own corporation.
So I either become an employer to my spouse or an employee of my own company.
Right.
Sounds a little bit like a legal puzzle.
Yeah, it can get a little complex.
This HRA thing sounds amazing, but pretty complex.
Yeah.
Is this something that I can DIY or do I need to call in the experts?
Well, while the concept itself is pretty simple, the actual setup and administration of an HRA can get pretty intricate. It's always wise to consult with a tax professional to make sure everything's done right. Even the author of this book, found it beneficial to work with a third-party administrator.
Makes total sense.
Yeah,
It's better to be safe than sorry, especially when dealing with the IRS.
absolutely.
Okay, let's shift gears from healthcare to another major expense category for, I think, most business owners' vehicles.
Okay.
I'm assuming there are some deductions hidden in those miles we drive for business.
You bet the IRS actually gives you two options for deducting vehicle expenses. You can choose the standard mileage rate, or you can choose the actual operating costs method.
Okay, break it down for us. What are the pros and cons of each method?
So, the standard mileage rate, or SMR, is kind of like the easy button. You just multiply your business miles by the IRS set rate for the year, which for 2020 was 57.5 cents per mile. It's pretty straightforward.
Yeah, that sounds pretty appealing.
Right.
So why would anyone choose the actual operating costs method?
Well, sometimes that easy button might not get you the biggest bang for your buck, especially if you drive a more expensive vehicle or have higher operating costs. Like if you have to do a lot of repairs or you have, premium insurance in those cases, actually tracking your expenses for gas repairs insurance. Even things like car washes and tolls might result in a larger deduction.
So if I'm driving like a luxury SUV or racking up a lot of repair bills, tracking those actual costs might be worth the extra effort.
Exactly. It's all about finding the method that maximizes your deductions.
Got it. But I have to admit, the thought of like meticulously tracking every gas fill up and oil change makes my head spin.
Right.
Are there ways to simplify that record keeping process, especially for that actual operating costs method?
Yeah, absolutely. There are some great resources out there to help you stay organized. The book's website, for example, has a free vehicle use log.
Oh, okay.
And here's a bonus tip: the IRS actually allows a sampling method for your mileage tracking.
A sampling method? What's that all about?
Yeah, instead of tracking every single mile you drive for the entire year, you only need to keep detailed records for a representative 90-day period, and then you can extrapolate your annual mileage based on that sample.
So if my business activity is relatively consistent throughout the year, I can essentially get away with only tracking mileage for 3 months.
Exactly.
That's a huge time saver.
Right, and it's completely IRS approved. Just make sure that 90-day sample accurately reflects your typical driving patterns.
Okay, that's a game changer.
Yeah.
Speaking of game changers, the book mentions a potential savings of $5,750 in deductions for 10,000 business miles driven in 2020.
Wow.
That's almost like getting a bonus just for driving.
Right. It highlights the importance of really taking advantage of every deduction that's available to you.
Absolutely.
Now, before we move on, I do want to address something that often comes up when we talk about business travel,
Okay.
which is what happens when those trips combine business with pleasure? Can you still deduct those travel expenses even if you're squeezing in some vacation time?
That's a great question. I'm sure a lot of our listeners are eager to hear this answer, myself included.
Right. So the IRS uses what's called a primary purpose test to determine if a trip is primarily for business or pleasure. It's not enough to just have a few business activities sprinkled in during your vacation. The main reason for the trip needs to be business related.
So, if I'm planning a family trip to Disneyland, but I also want to meet with a potential client in the area, could I make that whole trip deductible?
You could, let's say you schedule a breakfast meeting with that client, you document it in advance, you actually attend the meeting. You've now turned a personal day into a business day, which could make that entire trip potentially deductible.
Wow, so I could be sipping cocktails by the pool and still be on a legitimate business trip.
Well, not exactly sipping cocktails. Remember, you need to be able to show that business is the primary focus of the trip. But adding a strategic business activity to a personal trip can definitely shift the balance in your favor.
Mm, got it. What about weekends? Are those automatically off limits for business deductions since they're typically for leisure?
Not necessarily. The IRS actually has a rule called the Saturday night stay over rule.
Okay, that sounds intriguing. Tell me more.
So, if you can prove that staying over Saturday night will save you money on airfare, even though it extends your trip into the weekend, those extra days can become deductible.
So if I can find a cheaper flight that requires me to stay over Saturday night, I can essentially duck those weekend expenses.
Exactly.
I love it. It's like a loophole for extending your business trip and enjoying a mini vacation.
Well, it's not exactly a loophole, but it is a smart strategy for maximizing your deductions while making the most of your travel time.
Okay, I have to ask about cruises. Can you deduct a cruise if you combine it with some business activities?
Cruises, the IRS has some specific rules about those. So, expenses for conferences or seminars held on board a cruise ship are generally not deductible.
Oh no, so no tax breaks for those onboard business conferences.
Not so fast. There's a potential workaround. Instead of holding your business activities on the ship itself, what if you schedule them ashore at one of your ports of call?
Oh, interesting. So the cruise becomes just like a means of transportation to reach your business destination.
Precisely. The IRS might view it as luxury water transportation, but as long as you can demonstrate that the primary purpose of the trip is to conduct business in those ports of call, you could potentially deduct a significant portion of the cruise fare.
Okay, that makes sense. So if I'm spending a couple days in port for meetings the rest of the time,
Hmm.
enjoying the ship's amenities, I could still claim some deductions.
Exactly. Just remember, as with any travel deduction, documentation is key. You need to keep detailed records of your itinerary, your business activities, all your expenses to support those claims.
Great points. It's always better to be safe than sorry when it comes to the IRS. This whole travel deduction strategy is incredibly valuable, especially for those of us who love to combine work and travel. Okay, we've explored healthcare vehicles, even cruises, in this part of our deep dive. I'm ready to keep uncovering those tax saving gems. Welcome back to our tax saving extravaganza. I'm feeling pretty empowered by all the deductions we've uncovered so far.
Well, that's what we like to hear, and we're not done yet. There are still a few more treasures to unearth.
Okay, perfect. Now, I know tax laws can get pretty complicated, and there's one in particular that I've been hearing a lot of buzz about, and it's the 20% pass through deduction. It sounds promising, but also a bit confusing.
Yeah,
Can you break it down for us?
you're right. It can seem a bit daunting at first glance. This deduction, officially known as Section 199A, is specifically designed for what are called pass through entities,
Wow.
things like sole proprietorships, LLCs, partnerships, and S Corp, and it allows them to deduct 20% of their qualified business income or QBI.
Okay, so we've got pass through entities in QBI. Can you explain those terms in a way that even I can understand?
Sure, so imagine your business is like a pipeline,
Okay.
and the money it earns flows directly through that pipeline to your personal tax return.
Okay.
That's essentially what a pass-through entity does. It passes the profits and losses through to the owner's individual tax return.
Got it.
And QBI represents the net income earned from that business after you've accounted for all your allowable expenses and deductions.
So this deduction lets me shave off a significant chunk of my taxable income.
It does.
That's huge. But I'm guessing there's some caveats, right? Not everyone qualifies for this magical 20% deduction.
You're right, there are some income limitations for 2020. The deduction started phasing out for single filers earning above $157,500 and for joint filers above $315,000.
Okay, so if I'm earning more than those thresholds, I might not get the full benefit, but it's still worth looking into, right? Is especially if my income is close to those limits.
Absolutely. Every dollar saved counts, and this is definitely one of those areas where professional guidance can be incredibly valuable.
Makes sense. Now I want to shift gears to something that's been making headlines lately, and that is cryptocurrency. It seems like everyone's investing in it these days, but I'm not sure many people understand the tax implications.
That's a hot topic.
I'm definitely one of those people.
Yeah, and the tax rules surrounding cryptocurrency are still evolving, but the key thing to remember is that the IRS views cryptocurrency as property, not currency for tax purposes.
Okay, so how does that affect how it's taxed? Is it different from like how stocks or real estate are taxed?
It's actually quite similar. Just like with stocks or real estate, you'll need to pay taxes on any capital gains you make when you sell or trade your cryptocurrency.
Wait, so even if I'm just trading one cryptocurrency for another, say like Bitcoin for Ethereum,
Yeah,
that's considered a taxable event.
that's right. Each trade is treated as a separate transaction that could trigger a capital gain or loss depending on the price you bought the original cryptocurrency for and the price you traded it at.
Wow, that's something I definitely didn't realize. I bet a lot of people are making those trades without even thinking about the tax consequences.
It's a common oversight, and that's why accurate record keeping is absolutely essential in the crypto world.
Yeah.
You need to track your cost basis for each coin, the dates of your transactions, any gains or losses you incur.
So basically, treat it like any other investment and keep meticulous records, no stuffing those crypto transactions under the rug.
Exactly, and keep in mind the IRS is getting serious about cracking down on cryptocurrency tax compliance.
Yeah.
They've even started sending out what they call educational letters to cryptocurrency holders, urging them to report their transactions accurately.
Okay, so no flying under the radar with crypto taxes.
No.
Better to be upfront and compliant from the start.
Absolutely.
Mm.
And as with any complex area of tax law, seeking expert advice from a qualified tax professional is always a smart move.
Great advice. Okay, we've covered a lot of ground in this deep dive. We've explored home offices, healthcare vehicle expenses, travel deductions, the pass-through deduction, and even ventured into the wild world of crypto taxes.
We did.
It's been an incredible journey.
It has, and hopefully it's inspired you to take a closer look at your own tax situation and uncover those hidden deductions that might be right under your nose.
Absolutely. So
Lovely.
remember, it's not about finding loopholes or trying to game the system. It's about understanding the rules, claiming every legitimate deduction you're entitled to, and running your business in a smart and savvy way.
Exactly. And as we've emphasized throughout this whole deep dive documentation is keep detailed records of everything related to your business, your income, your expenses, your mileage, your meetings, everything. And when in doubt, seek professional guidance from a qualified tax advisor.
Yes.
They can be your best ally in navigating the complexities of the tax code and ensuring you're maximizing your savings legally and ethically.
Couldn't have said it better myself. So, folks, we hope this deep dive has left you feeling empowered and maybe even a little bit richer. Remember, every deduction you claim is a victory not just for your bottom line, but for your overall financial well being.
Until next time, happy deducting.